take a moment to introduce our guest for today. Today we have with us team GreenEdge Wealth, and we have Digant Haria and Resha ma'am. So Digant Haria, co-founder and partner of GreenEdge Wealth, where he help his clients building stock and bond portfolios. His past experience worked as a credit analyst for Axis Bank and J.P.Morgan. So for almost 11 years, he had covered over 100 plus companies in the space, and he possesses a very rich experience in the BFSI space. So he was a stock analyst at ICICI Securities and Antique Stock Broking previously, and he had been voted as India's top analyst in finance sector by Asia Money and Thomson Reuters. So he had those who are regular. They must be knowing that he is a regular guest on forums and publications of the likes of CNBC, ET Now, TIA, IIC. And as far as his education is concerned, he's an engineering graduate in computer sciences, and he did his MBA from NITIE, and he's a CFA holder. A very warm welcome, Digant. And Resha ma'am is also a co-founder and partner at GreenEdge Wealth Services. She is amongst the first 11 women who are registered with the SEBI and into investment advisory in India. And her past experiences with the ICICI Securities and Standard Chartered Bank, and she has also worked in Yes Bank. So, having witnessed poor levels of financial awareness amongst the working professional and especially the working women, she thought of an idea so as to create green edge wealth. The idea is to, spread awareness on financial awareness amongst the classes mentioned, and she is very passionate about long term investing, portfolio building, and helping investors helping with the education of investors who are just beginning their journeys. And she is also like the idea of green edge wealth was her conception, so which we would be knowing from her down the line. So she is also an MBA from a reputed institute, Jamnalal Bajaj Institute of Management Studies. And so Digant and Resha ma'am, I would request both of you to go one by one, and would appreciate if you tell us about how it all started for you, and then would like to know more on the Green Edge Wealth services. Yeah, thank you. Over to you.
Yeah, great. Thanks, Prince, for the introduction, and thanks for having us here. We are really excited to talk about the topic at hand. So, just before we start, I would like to briefly introduce our firm. So, GreenEdge Wealth Services is a SEBI-registered investment advisory firm. We are based out of Mumbai, and we essentially started in 2015. With just stock advisory for our customers, right? But over a period of time, as we deeply engaged with them, did their financial planning, risk profiling, we realized that just having exposure to one asset class, which is equities, and that was so volatile, it may not really suit a retail investor's appetite, and it's important to diversify, right? And especially we saw that on the fixed income side, while most of them had exposure to bank FDs and provident funds, but bonds essentially were missing, right? And that's where we thought that introduction of bonds in the fixed income portfolio can help customers earn higher yields while managing their risks at the same time. Right, so around 2017-18 is when we started offering bond advisory to our customers as well, and then around the same time a lot of these asset management companies started launching very these thematic mutual funds, like for instance one could start investing in the US markets or the Chinese markets via these mutual funds, and then some more niche mutual funds like thematic funds, like let's say investing in energy companies around the world, and then just semiconductor companies in Taiwan and so on and so forth. So that's when gradually we also introduce these thematic mutual funds, right? So that's broadly been our evolution over a period of time, and maybe Digant, you can just elaborate a little bit more on the stock and the bond strategy.
Yeah, thanks, Resha, for that. And thank you guys, all of you, for joining on a Sunday evening. So so yeah, I think on the stock portfolio bit, we at GreenEdge, we believe in running a diversified portfolio. Like when we started, like all young people, lot of josh, and we want to really do concentrated investing and all. But the more you know about the Indian markets, the more you learn about Indian economy, you realize that how blessed we are to be in a country which has 6,000 listed companies, and maybe 500 or 600 of them are really investment grade companies. So over time, we learned that running a diversified portfolio really helps you get exposure to various different parts of the economy. It also reduces the risk. At the same time, you learn more and more sectors. Being concentrated, you stop learning about a lot, and in a growing economy like India, you can never stop learning. So we run a diversified portfolio, but there are five or six main themes which run through our portfolios. Okay, so food, fashion, finance, technology. Technology both in the real world, in the digital world and in the physical world. So we think that somebody who offers a compressor and a motor or a pumps, a factory technology is one side of the technology, which we call the physical world technology. And then there is software, which is the digital world technology. So by technology we mean both of these worlds. And then the real economy sectors, there are very very large number of sectors, like say a packaging, paper, sugar, metals, mining. These are all cyclical sectors, but they still offer a good investment case if we get the cycles right there. So our stock portfolios are diversified. We try to, these five six are the main themes. On the bond part, which Resha mentioned, I think I'll talk a little bit more on the bonds part. Let's see, in India, most of us keep our money in bank deposits. What do the banks do with that money? They lend it to some other companies. Just for example, you lend it to the bank at 7%, and bank lends it to a corporate or a small business at 10-11%. So in bond portfolios, what we try to do is we try to eliminate the role of a bank, and we directly lend to the corporates. And now India has a reasonably vibrant bond market already. Just for example, you guys would know there's a listed company called Spandana. Okay, the Spandana is a microfinance company. Then Shriram Finance, it's a vehicle finance company. Then Indostar is again a vehicle finance company. See, these are all finance companies. They need money all the time. They borrow from the banks, and they borrow from the bond markets also. So here, instead of we giving money to banks and banks giving money to them, we directly invest in their bonds, and in this way we can earn a good amount, say 9 to 11% kind of yields is what you can earn. Obviously, there is a little more risk involved versus a bank, but based on the areas where me and Resha have our expertise, we try to reduce those risks by analyzing the balance sheets, the way the promoters conduct their business, the kind of lending they do, and the kind of risk controls they have. So these are two main things, philosophies around managing a stock portfolio and managing a bond portfolio. I think both of them have their importance. I'm sure a lot of you guys are young, early in your career journeys. So more focus has to be towards equities. But as you make money, as your wealth grows, as your age grows, I think the fixed income will also be very important, because when you are in your late 30s or early 40s, you would also want to live a little more life, work a little less, and you want some income coming which is outside your job. So that is where all these fixed income portfolios play a very important role. So yeah, that's about it on Green Edge. I think back to you, Prince. Maybe we can just start the topic of the day, which is food and finance and opportunities in these two sectors.
Yeah, Digant. So, Digant, it would be like I would request you and Resha ma'am that you go one by one and monologue basically on the both the sectors, and after that we will take questions from the attendees, and I'll ask questions on my side as well.
Perfect, perfect. Resha, you can start with the food sector, and then we can go over to the finance sector.
Sure, sure. Thanks, Digant and Prince. So, yes, so I'll be talking about foods, right? Of course, this is an evergreen segment. very, very big in size because, if we talk about the frequency of usage of some of these categories, the size can become, as large as, around 13, 14 lakh crores, right? So, and especially with this shift happening from unorganized to organized, right? The growth opportunity for, some of these listed companies and organized players only becomes bigger, right? So just to give you a sense of the size of some of these categories, like dairy, for example, is a 7.5 lakh crore segment. Then pulses is 1.5 lakh crore. Spices, savory snacks, 75,000 crores each, right? So the opportunity sounds very big, very, very exciting. But, despite such large sizes, what we see is that, only two or three players, in most of these segments tend to become pan-India and, command a big market share. Uh, for example, in biscuits, Parle products and Britannia together command 60-65% market share. In spices, right? The top three players would be commanding 40% market share. In dairy, again, there are just two, three companies which can qualify as, being called as pan-India companies, right? So this essentially shows that it is very, very difficult to scale here. And there are three ingredients that we've defined, which is required to scale a food product or a food brand, right? I'll talk about each of these. The first is, palatable product. So uh, no substitute for this. Consumers have to find the product tasty, and this becomes very difficult because India is a heterogeneous market, and regional palates, recipes, they change every 150, 200 kilometers, and that's why even MNCs like HUL, Nestle, we keep hearing that it's all about winning in many Indias, be it with your product portfolio or your distribution strategy, right? And I'll just quote two examples here, right? So if we take examples from traditional ethnic Indian food categories, okay, there essentially we've seen that, Indian companies, domestic companies tend to dominate versus the MNCs. So, for example, if we take spices, right, over here, Everest, MDH, MTR, all domestic companies, they have around 40% market share. MNCs are almost absent here. And Everest is the only pan India player. Uh, if you look at traditional snacks like, bhujia, gatia, namkeen, right, Haldiram's, Bikaji, Balaji, they command almost 50-55% of the market. PepsiCo hardly has 3% market share. So this is on the traditional Indian categories. If we talk about Western categories like, your burgers, pizzas, noodles, even all these McDonald's, Domino's, even they had to kind of tweak their product offering to taste to suit the regional palates and make it appealing to become successful, right? So that's in the first part, which is making a palatable product. Second is affordable product, right? So this is pretty intuitive. Now we are a very price conscious market. In order to achieve scale, a product definitely has to be affordable in India. And in India, essentially mass market product is defined as anything that sells that costs to the customer, less than rupees 200 per kg. Now, for example, Parle G biscuits, right, very, very affordable and accessible. They sell at almost 80-85 rupees per kg. Okay. Now, again, to make a product affordable, it is also very important that you make your product available at lower SKUs or lower price points like rupee 5, 10, 20. These are very, very important price points in the Indian markets to drive penetration, drive trials, etc. So, for example, Parle-G is a billion-dollar brand today, but it derives majority of its sales from 5 rupee SKU. Yellow Diamond, from Pratap Snacks derives almost 80-90% revenues from rupee 5 SKU. Right. So while yes, being an affordable product is very important, and we are seeing premiumization theme picking up, but it is slow and gradual as the per capita income increases. Now, just for example, a category like chocolates, right, which has been here for over last so many decades, the share of premium chocolates in this category is just 30% after all these decades, right? So that's on the second part, which is making an affordable product. And the third is a very, very important point, which is having an efficient supply chain and a distribution network. Now, most of us love our Maggie noodles, and it would be worth noting that Maggie, despite having the backing of a MNC giant like Nestle, it was loss making for the first 10 years in India, right? This just shows how important, how difficult it is to actually make a profitable brand or product in India, right? Because there are investments that happen on the product development side, innovation side, because you are subscale, your bargaining power with your suppliers is low, your manufacturing costs are higher, your logistics costs will be higher because you may not have a dense distribution network. You may be sending partial truckloads versus full truckloads. You may not have the marketing monies. On the distribution side, you're really fighting or for shelf space, not only with players in the same category, but also, with players of, other categories in the retail shop. And for to have your product in the shelf there, you may need to extend higher credit to the retailers, higher margins, etc., which adversely impacts your profitability and working capital. Right. So again, very, very difficult to have an efficient supply chain and distribution network. So these are essentially, the three ingredients making a palatable product, affordable one, and having an efficient supply chain and distribution network, which are very important to be able to scale up your brand or product. Right now, see, there are many food categories to talk about, right? Chocolates, spices, noodles, breakfast cereals, biscuits, etc. Right, but there are not many meaningful pure play listed companies in a lot of these categories. Hence, I will talk about dairy for maybe the next 10 minutes, where we actually see investable opportunities currently as well. Okay. So if we look at the dairy industry, right, in my opening remarks, I did mention that it's one of the largest. It's almost 7.5 lakh crore market, right? But if we see, it is dominated by liquid milk, which is almost 65% or 5 lakh crore of the market, and maybe value added products is just 20%. So this segment is seeing growth because there is a shift that is happening from unorganized to organized. Organized is at 35% of the total market, and even within the organized, private players are gaining market share from cooperatives. So while yes, the dairy industry is growing, maybe at around 5 to 10% CAGR, but your organized is growing at almost 2x of that rate, and within that, value-added products are very small, and maybe they are growing at roughly 3 times, right? So just to give you a sense of how small value-added products are, like cheese is just 7,000 crores, ice cream is just 15,000 crores versus let's say your liquid milk at 5 lakh crores. Right. Now, we're going to talk about, there are three main competitive advantages, when we talk about the dairy industry. And if a company is able to crack three of these, that can create huge entry barriers for, the other players. The first and the most important one is, how do you procure the raw milk, which is a raw material to make dairy products. Okay. And this actually is the biggest competitive advantage in this particular sector. So there are essentially two ways to procure milk. The easier one or the shortcut method is uh, these companies, they hire milk contractors or middlemen whom we call agents, milk agents, right? Very easy to kind of quickly do that, right? Because also your investments, both your capex, opex will be a lot lower. Right, but on the flip side, you will be at the mercy of these agents. Your quality and quantity may be inconsistent, and you may have to pay the agents a higher price, okay, to procure your milk. So this is easy, quick, less effort intensive, but of course, inconsistency and on quality and quantitative side. Right. The other is the more difficult one, which is procuring directly from farmers. Now, see, there are around 10 crore farmers in India. Each one of them, on an average, are having just 2 to 3 animals, and the yield per animal in India is also very low. Okay, so maybe if a dairy company goes to an average farmer in India, he will just get 5 to 6 liters per day, which effectively means that if you are going to procure directly from the farmers, it's going to be a very, very fragmented, granular, and a regional exercise. Okay. Plus, developing and building relationships with farmers takes decades. You never have to say no to a farmer if he's giving you milk. You have to pay them a fair price, make prompt payment, right? Plus, there is a lot of capex and opex involved. So you need to set up a collection center for milk at village level at each village. Then that needs to be supplied to a milk chilling center, because temperature control for dairy product is very, very important. And then you ultimately send it to a dairy processing plant. So this method is very, very difficult and long gestation, and that's where most of your MNCs have failed over here, because it's such an intensive and a long gestation process. And that's why we see in the dairy industry, it's essentially the Indian domestic companies which are the leaders. Maybe at national level, you have Amul, Mother Dairy. Within private dairies, you have Hatson, and so on and so forth, right? Even if you look at our own homegrown company, Britannia, right? So they entered the dairy business around 2000. After all these years, right, their dairy business is just 500 crores in size, which is much below their stated expectations as well. Right, so this is the first competitive advantage or the entry barrier, which is direct milk procurement. The second one is, having a right product mix, right? Now we've seen there is liquid milk, ghee, SMP, these are all commodity products, right? And then there are value added products like, curd, paneer, ice cream, cheese, whey, etc., etc., right? But having a product mix gives you that right balance between growth, profits, and return on capital employed, which is very, very important. Now, see, for example, liquid milk, though it is the largest 5 lakh crore almost market, right? But the growth here is slowest because it's a very well penetrated product. Margins are the lowest and they are very cyclical. Okay, so margins are hardly 4 to 6%. Plus, it's very politically sensitive to kind of keep raising your milk prices with inflation, right? And then ROCs, if we see over here, are very, very high because it's almost a negative working capital product, and your asset turns are very high, right? Then if we look at low shelf life products like, let's say, a curd, which is a value added product but has a lower shelf life, there also margins can be decent, moderate, growth is decent, 12-15%, and ROCs can be reasonably high, 15-20%, right? But if we look at some of these emerging value-added products like ice cream, cheese, etc., which are long shelf life, which require a lot of investments in cold chain, etc., where your inventory days can be higher, your receivable days can also be higher, right? Though the growth is very high, 15-20% in these segments, margins are also high, but your ROCs in the initial stage when you're subscale can be low, and there is a possibility to scale up these ROCs for these segments, with scale, right? Because as you grow in scale, you get those benefits of economies of scale. Plus, if your brand is strong, you have some differentiation. You have some pricing power. So that is the second advantage in terms of having the right product mix. And lastly, the third competitive advantage is, let's say you have all of this, but you also need to have a great marketing and distribution, right? And distribution is very, very difficult in a segment like dairy where temperature control, etc., becomes very important. So there are, four types of distribution. You have something for fresh products like liquid milk, curd, yogurt, then ambient products, milk powder, ghee. For chilled, there is a chilled system, which is for butter, cheese, shrikhand, and then, for frozen ice cream, paneer, you have a separate one, right? Now, just to give you an example, for example, liquid milk is essentially, the shelf life is just 48 hours. So it has to reach the customers within 30 hours of sourcing, which effectively means it, restricts the area in which, you can transport your milk. So that's why it's a very, very regional play. So strong marketing and so marketing is also very important because let's say brands like Amul, Hatsun, Arun ice creams, they are very, very strong over a period of time. They have built those brands, and building strong brands, healthy distribution, gives those healthy margins, pricing power, and, improved ROCs. So these are the three competitive advantages. Now, I'm going to be talking very briefly about two companies here, Hatsun and Heritage Foods, right? So both these companies, we are invested personally, and we also advise to our customers, right? So that's a disclaimer here. And please, if you all were to act on any of these companies stated here, please consult your financial advisor. So the first one is Hatsun, right? It's been a consistent performer across parameters. It's got some of the best in class, right? Milk procurement. It procures 100% directly from the farmers. Over the decades, they've built very good relationships with farmers. They have a dense procurement network. They've done a lot of investments, both on the capex and opex side, right? Even if you look at their product mix, one of the only companies to reduce the liquid milk share to 50% of their revenues. So the share of value-added products is almost 45% of their revenues, and they are number one, number two, number three in a lot of these categories, right? So in number one, they're number one in curd if we exclude cooperatives. They're number three in ice cream pan India. They're number one in ice cream in South, and curd ice creams, they're almost touching 1,000 crores in revenues. And they're also known for innovation. They keep trying a lot of things. Chocolates was one category, which they entered. They tried pizza as well. They rolled it back because it didn't work out for them. But yes, innovation is also in their DNA. And lastly, marketing and distribution. So, see, it's in the DNA of the company basically to control all aspects of their business, right? From back-end supply chain, milk procurement, uh, and even distribution. Okay, so it's a 100% B2C company. They have, built these kind of, 1,000 crore curd ice cream brands almost, with a strong branding and without much ad promotion, and they control even their distribution channels. So they do not sell through any middlemen. They don't have a distributor or a wholesaler in between. They essentially sell through these retail stores where they help those store owners with the capex as well as the opex, but they have very good control over what they sell at what price, etc., etc. Right. So Hudson clearly very capable management and with a consistent past track record makes it a very, very quality company. The next is Heritage Foods, right? So, which we believe is on the cusp of change. So, and I'll talk about it why. So, if you look at milk procurement, again, almost 85% direct milk procurement. Of course, there is a scope to improve this to, take it up to 100% direct milk procurement from farmers. Product mix largely dominated by liquid milk at around 65%. Within value-added products, it's a 26% share in terms of their revenue for value-added products. And curd is the only value-added product to cross 100 crore revenue. So curd is at around 550 crores revenue. And despite having tried launching several products like paneer, drinkables, dairy sweets, they've not really crossed 100 crore revenue mark in any other product, value-added product except for curd, right? And this is because they've traditionally been weak in marketing and distribution. So they are again a 100% B2C company, but 65% of their revenues comes from selling via middlemen. But we believe that this is changing. So around 1.5 years back, they hired a new CEO who's from ex-Coke, right? And they are trying to change their distribution to making it more FMCG oriented, reducing dependence on middlemen, right? So we believe that that is why Heritage is on the cusp of change. Plus, growth has started coming back. If you see over the last 3 quarters, almost 800 crore revenue run rate that has been happening, and Heritage clearly, if the management continues its focus on marketing and distribution and keeps delivering, then this could be a good mean reversion candidate. And if we look at both Hudson and Heritage, it could be a good combination of growth and value respectively in the portfolio as far as the dairy segment goes. Right. So now, currently, if we talk about this sector, yes, it is facing a lot of inflationary pressures, which is weighing on the profitability. Right. But and we think that this pain will kind of continue for a while. But in terms of long-term growth prospects, as I spoke about, very, very bright. Right. And I think with that, I'll close my opening remarks on dairy, and maybe Digant, over to you. You can talk about the finance segment.
Uh, yeah, hi, this is Digant this side. Am I audible? Maybe Resha or Prince, any one of you can just say a yes and I'll start.
Yeah, Digant,
Yes,
you're
Digant, you're
audible.
on.
Okay, thanks, guys. Yeah, so thanks. The dairy part on the food bit, a very detailed one. I'll try to, spend the first 5-7 minutes on, defining a macro framework of for the finance sector. That why is finance sector so important or so attractive as a place to invest? Because see, it's a
I can hear you. And Resha ma'am, you can also try speaking. So,
I am also.
Digant, you can start from where you left because we all heard you till you spoke last.
Okay, so I was just speaking about that this is the whole sector, entire sector which can grow at 12 to 14%, but not every player has been able to do that. Just about 7 or 8 banks and 7 or 8 NBFCs. So 15 out of the 100 players in this sector have only been able to grow consistently year after year in this sector. So there is something definitely difficult about this sector if I have to think long term, what drives long term success. So that is where, as investors, we should really focus on is which are the companies which are building the right businesses so that they can capture this growth. So even right now there are we always have a lot of narratives that okay, the interest rates are high, the global markets are volatile, there is some bank default in the US, there's Adani issue. A lot of these issues come, but the banking sector, the structure in India of Indian economy and the sector itself is such that we will still grow at 12 to 14% for the entire decade, despite whatever is happening globally. and locally. So the entire discussion will be directed towards finding good players in each of the pockets of the finance sector. More specifically on what drives success in this sector is, number one, you have to be able to establish trust. Why should you be able to establish trust? Because as a bank or as an NBFC, I am always going to need uh, depositors or money. Money is my raw material, and people are going to park money with me only when they have a reasonable confidence that I will be able to return back that money with an interest. So that is one. Second is, you always have to raise equity, because if you are growing, uh, and growing fast, you definitely need equity capital also. So you need the trust of the equity markets, the equity investors, time and again, maybe once every 3 to 4 years, most of the good companies come for capital raise. So now, how do you build that trust? The trust cannot come overnight. Trust is something which gets built over a very, very long period of time. And the ingredients of building trust are the same. All of you guys would know this, that you should hire the right kind of people. You should have the right kind of processes. And being in a financial business, risk management is something which is very important. And see, once you've established these good processes and good risk management practices, you also have to ensure that you follow them every single day, every single month, every single year. And year after year, doing this is what differentiates the good and the bad players. We will talk more about each of these pillars as we discuss the sub segments, because then otherwise the macro discussion becomes a bit boring. uh, Specifically on the current narratives, a lot of people think that the interest rates are peaking, the margins are peaking, and then banking sector may not be able to do well. I think, see, we have to understand two things. That one, the fundamentals of the sector are very, very strong. By fundamentals, I mean the balance sheets of the banks and NBFCs. Most of the NPAs have been cleaned up, and especially after the ILFS crisis, the leverage is also down. The debt to equity of, so typically an Indian bank operates on 11 times leverage, which means the debt to equity ratio would be around 11 times. In the United States, this number would be between 16 to 20. So it is safe to say that India is, like, half as risky as US, and that too, hardly anybody operates at that 11 times debt equity. Most of the Indian banks are between 8 to 9 times debt to equity. So which means that we are roughly 70% less levered compared to the US. So that itself makes us very, very safe. Second is, the regulatory structure in India is so strict that RBI is a much more powerful central bank compared to the Federal Reserve, because in US, there are more than 4,000 banks. There are industrialist owned banks. There are community owned banks. There are regional banks, and a lot of them, Federal Reserve does not have all powers over them. Whereas in India, we hardly have 35, 40 banks, and the regulation is so strict, whether it is in terms of the rules surrounding taking the deposits, the rules around investing your SLR portfolio into different kind of bonds, or whether it is in terms of your NPA recognition, and whether it is in terms of the debt equity or the capital that you can operate with. So I would say that the banking sector is extremely safe, extremely robust, but the global environment is not very, very suitable for high growth, because whenever the interest rates in US are high, the FIs are pulling out money, the liquidity is going to be tight, and in tight liquidity environment, not the entire sector will not be able to do very well. By very well, I mean 15% plus kind of growth, I think. But we should still be able to do 12 to 14% kind of growth at the sector level, despite all the macro challenges that are there. I don't think the Silicon Valley Bank issue, which is like the most talked about, that should not really have a contagion, because it is very small even in the context of US. So we should not worry much about that. And as far as the rising rates and everything is concerned, I don't think India is going to see rates beyond 7.5 to 7.75%, purely because we are already our interest rates are already positive. The real interest rates is nothing but your interest rate minus your inflation. So in India, the GSEC is at 7.5, the inflation is at 6, which means that you are still earning 1.5%. 7.5 minus 6, which means 1.5% positive rates are still there in India. Whereas if you look at the US, the inflation is running at 6% and the Fed rates are close to 5%. So they are still at the negative real rates. So I don't see a lot of risk in terms of these macro things. So we can safely put all the macro things uh, to side for now, and we can focus more on micro and the opportunities in the sector. Uh, so now coming to the sector, it's a very large sector, so I'll break it down into 10 different pockets. So the first pocket is the large private sector banks. We have four banks here: ICICI, Axis, HDFC, and Kotak. See, these large private banks have been a sort of very consistent companies. They have very good liability profile, like their deposit franchise is quite good, their rate of borrowings is very low, plus they are able to lend in many sectors, like they can lend to corporates, to retail, to agri, then SMEs, all these new age digital lending. So I think all of these banks will create wealth over the next 5 to 10 years. But if somebody has to be, how do I decide which of the four banks should I own? So I think it's all about, these all four banks are good banks, but what can make a difference is the leadership. So in very large banks, we focus on the leadership because that is the only thing which can make a difference. Because changing the course of a very big organization is not easy, and you need a really strong leader. So when I analyze all the four banks, I think ICICI Bank has the most can actually be the most consistently performing bank for the years to come, because the leadership issue is absolutely sorted. They have made the right investments in the new age technology and the traditional technology, and I think a lot of things are going right for them. So Axis Bank, ICICI should be the most consistent one. And if somebody wants to play some bit of turnaround, I think Axis Bank offers a very good turnaround opportunity, because Axis Bank suffered a lot, between 2014 to 2018 under the previous CEO. And a lot of that cleanup act started in 2019, but then COVID again came. So I think Axis Bank is somewhere on the cusp of turnaround. It's trading at much lower valuations than ICICI. If the turnaround is successful, it will trade close to ICICI Bank and not at a significant discount. So maybe slightly more returns can be expected at Axis Bank, because the franchises are quite strong, Axis and ICICI. And as far as HDFC and Kotak Bank is concerned, I think both these banks are reasonably valued, and both of them are undergoing leadership transition. So maybe they'll do well, but probably not as well as Axis, ICICI. But yeah, these are like very consistent companies. You don't have to worry about risks here. You should have to only worry about where can I make more returns here. So that's about the large private banks. Then the next set of large banks is the public sector banks. They've been quite hated banks for, and mostly for the right reasons. But there is some bit of turnaround which has genuinely happened after 2016 in this space. So in this space, SBI is the SBI is the only one which has good capabilities across the three pillars of banking. So the three pillars of banking are, one is the deposits, second is the loans, like can you lend in a nice way, and third is the risk management around all of this. So uh, SBI has a very good deposit franchise, obviously, because it has the accounts of all the state government employees, and it's the oldest bank and so on. On the lending side, SBI is the only public sector bank which has capabilities across corporate, retail, and SME. Retail home loans everybody can do, but beyond home loans, most other public sector banks cannot do anything. So they are highly dependent on corporate loans reviving back. But SBI is someone who has a very large personal loan book. They have done quite well in auto loans. They have done quite well in gold loans. They also have this, Yono SBI app where, it's become probably the most used app in the country. Their technology stack is probably comparable to an ICICI bank, which has the best technology stack amongst all banks in the country. So I think SBI is one which will be the consistent amongst the public sector banks, and of the other three or four banks, which is mainly the Punjab National Bank, the Union Bank, Bank of Baroda, Canara Bank. I think Bank of Baroda is someone who has who has better capabilities on the retail side. But the other three, they are really far behind in terms of capabilities on lending to the retail side. And why I'm focusing on the retail side is because, see, the next 2 or 3 years we'll have a good growth on the industrial side, or the corporate lending side. But then corporate lending is always cyclical. Corporate lending is never structural. And when you are looking at long investing horizons, you want that my bank should have some presence and expertise in areas which are structural. So retail loan growth is absolutely a structural growth area, and that is where only SBI scores well amongst the public sector banks. So people interested in public sector banks should look them in this light, and based on our assessment, SBI is a clear winner. Within the others, you have to keep on seeing that who is doing what, and you can time and have some trading bets. But yeah, very long term bets are difficult in the next four public sector banks. Then I'll come to the mid-sized private sector banks. By mid-sized private sector banks, we typically refer to a Federal Bank, an IndusInd Bank, a Ratnakar Bank, IDFC Bank, City Union Bank, Karur Vyasa Bank. There are 9 or 10 such banks, even DC Development Credit Bank. So see, these banks are typically, they are always in a struggle period, and sometimes they do really well. Why do I say that is because, see, these mid-sized banks are stuck in what is called as, the mid-sized trap, which means they cannot grow much, nor can they, nor can they change their path very easily. Just for example, let's take for example a Federal Bank. Okay, Federal Bank has a brilliant liability profile. Okay, because lot of South, it's a very popular bank in South India, and they have a lot of transacting customers. So liability side is very good, but on the lending side, they have consistently disappointed over the last decade. That whenever they become aggressive and they try to lend at a higher rate outside their states of Kerala and Tamil Nadu, they suffer a lot of NPAs. So this will tell us that okay, Federal Bank is nice, but it cannot grow fast because they haven't invested enough beyond their traditional home markets. Like the big markets, in lending markets in India is Maharashtra, Gujarat. These are like very big markets, and if you are under invested in these markets, you will not be able to capture that growth which is really happening in the sector. So Federal Bank does not have much problems, but the only problem is that they are not able to grow because they haven't done enough investments. And now you may ask, why are they not doing enough investments? Because see, you cannot go so easily to a new state, hire big teams, and start lending from tomorrow. You have to do it gradually, slowly, and only then that happens. So I think Federal Bank is a typical example of bank which can do very well in the next 2 3 years because the economy itself is going to do well. So Federal Bank will do well, but over a longer periods of time, it's not very easy to say that Federal Bank will be able to capture that 15% growth which the country is offering. So similarly, IndusInd Bank is something, they had a niche in microfinance and CV finance. That is where they earn a lot of money from. But both of these segments itself are cyclical. Like commercial vehicles have their own cycle, microfinance has their own cycles. And we saw during the ILFS crisis and during COVID that, they get hit so badly during those times. And see, in lending business, the problem is that if I don't have a great liability franchise, so IndusInd Bank does not have a great liability franchise. I'm sure out of a lot of you on the podcast, how many of you would have IndusInd as your primary accounts? Very few of you. So IndusInd Bank is forced to offer higher rates, like they offer 6%, 7% to their savings and deposit customers, so that people come and deposit the money there. Now, if my borrowing costs are going to be high, I will be forced to lend at a higher rate because that's the only way I can make some margins. And when I lend at a higher rate, I'm trying to take more risk by going into sectors like two-wheeler, commercial vehicles, and microfinance. And these sectors will do very well in good times, but in bad times they'll bite you also very hard. So which is why this bank is caught in that kind of a trap. Similarly, Ratnakar Bank or RBL is also stuck in the same kind of trap, that they offer very high rates on the deposit side, and then to compensate for that, they are lending on the credit card and the microfinance side very aggressively. And then when the cycle is bad, you get really stuck. No, but then the investors don't invest, the stock goes below book value, and then you cannot participate in the next round of growth. IDFC Bank also has a similar problem, that on the liability side, they have built it in the last 3 4 years by offering very high interest rates. uh, it's fine in good times, but they have to lend at a very high rate, so they lend at 13 14%. And in India, when you go out and lend at 13 14%, there's a lot of risk which comes in your loan book, because that segment is risky. And plus, so fast, when you build a retail team, you don't get loyal employees or employees who can really stick to a process. So IDFC Bank is trying to do a good job, but it is also stuck in the same mid-sized trap which is there. The same goes for City Union Bank. Like, they had built a niche around the Tamil Nadu, the small businesses of Tamil Nadu. But once they went outside Tamil Nadu, they never had a good experience. So this company also suffers from size and growth constraints. So this is a space where you have to pick and choose your medium to short term kind of investments. Long term investments here are very difficult to make because of the problems which I told you. So that's about the mid private sector banks. Then there is a segment called small finance banks. There are 10 small finance banks, three of them are listed. So I think they have even bigger struggle than the mid-sized banks, because when you are just a microfinance company, you have to focus only on one thing. But when you become a bank, you have to focus on 10 different things. You have to focus on deposits, on bank branches, on RBI regulations, priority sector lending. So I think all of them have messed up in a really big way. I think except for an AU small finance bank and an Equitas bank, everybody else is struggling a lot. So example, Ujjivan and Suryoday, these were microfinance companies which converted into banks. They are hardly able to do anything beyond microfinance, and they have to spend like hundreds of crores every year on the banking transformation without any good outcome. So I think Ujjivan will do well because the microfinance cycle is reviving, but on the banking side, they will continue to struggle. Equitas and AU Bank, these are the only two who have been able to build some kind of a franchise. But in Equitas, there is again a challenge of who will be the leader. Like right now you have Vasudevan, who was the founder, creator, and he's still running the company. But that uncertainty is always there. AU Bank is quite expensive for the kind of franchise which it has built. So I don't see much of real long term opportunities in this sector as well. Like something like an Ujjivan or a Bandhan can offer a cyclical turnaround, but that's a 9 month, 12 month, 15 month kind of good times, and then again you will enter into a struggle period. So small finance banks is also an area where one has to be very careful if you invest here. Like, you really enter when stocks are cheap, and you have to get out when things are going good. After that, there's housing finance companies. Not a fan of this sector because banks are always, there to compete. Not easy to compete with the banks. Only way you can grow is you have some affordable housing portfolio where banks are not there. But all the affordable housing companies are trading at valuations which are sky high. Someone like an Avas or an Aptus. So they've built a good business model of how to capture the informal economy. All of them have reasonably good models. They have good risk management. They have good teams. So all the criteria which is needed for good companies is there in these housing finance companies. But obviously the valuations are so high, and these are all private equity driven companies. So private equity driven companies have their own challenges in terms of, they will exit at every, periodical interval and so on. In the traditional housing finance, there is PNB Housing, there's Canfin Homes, there's Repco, HDFC Limited, which will become an HDFC Bank. But we're LIC Housing. We're not really positive because once HDFC Limited merges with HDFC Bank, they'll roll out the housing finance product from 4,000 branches, and it will really not be easy to compete with the bank. So housing finance companies long term, it's a really difficult sector to invest. Short term, yes, there is a big tailwind here because the housing loan rates have gone up. People are converting their 15-year housing loan into 22 years housing loan to keep the EMI same. So the income line items for these housing finance companies will look very good in the next 1 year. But again, it's a medium to short term kind of a good outlook which is there here. Then comes the CV finance. This is quite interesting because financing of commercial vehicles is not a very easy business. Banks are not very active here. So NBFCs have some sort of right to win in this sector, especially if you have a good network on the ground. Like, if outside the cities, if you have good presence in major transport hubs, in major markets, this is one space where you can grow, you can make margins, and you can make good ROAs also at the end of the day. So Cholamandalam has been the best player here. Again, why has it been able to grow and maintain profits and not report large NPAs? Because they have done those investments in people, process, and risk. Now, just to say, give a little more details that Cholamandalam always had a policy that we will not have any single state contribute more than 15% of our portfolio. So they naturally diversified into so many different regions. They also had a policy that no product can be more than 15% of our portfolio. So they diversified into heavy commercial vehicles, mid-sized commercial vehicles, tractors, used cars, used CVs. So if you look at the portfolio, it is so well diversified that a slowdown in one geography or one product is not going to impact Chola. And even on the customer side, they have diversification that they give loans to customers who are operating in the agri economy, industrial economy, mining economy, and in the consumption economy. So four kinds of customers, they are present everywhere. So they have built this company in such a brilliant way that this advantage is going to stay them for decades to come. And like their risk management is also so strong that if the customer misses one EMI payment, the second day the branch person will call, the sixth day the relationship manager will go and meet him, and then they will chase him. So the all lot of these things come together to make a good lending company. Chola has those ingredients. Obviously it is well priced, but it's a good company. Then you have Sundaram Finance, which is like the oldest company, and once upon a time it was the best company, but they were so conservative that they never invested in new areas, and they just got left behind. The interesting company here, according to us, is Shriram Finance. The largest used CV manufacturer. They ran into some problems because of the management issues which were there. But they are sitting on a good franchise, a very profitable franchise. So we are seeing a good recovery in the commercial vehicle sales and in the commercial vehicle cycle itself. So I think these are ingredients where Shriram, a company like Shriram, can really perform. It is India's third largest, and after HDFC gets merged, it will be the second largest NBFC in terms of size. It is smaller only than Bajaj Finance in terms of size and profit pool. So Shriram is something which can turn around. So Chola is a very very consistent company. Shriram is something where you play the turnaround. Uh, so that's on the commercial vehicle side. There was this company Indostar and Poonawalla. I think Poonawalla is exiting the vehicle finance space. Indostar is going through troubles. So I think we have to give them their own time to sort out their issues. Then the next big space is consumer finance. The three or four companies which are there here. One is Bajaj Finance, the other is Muthoot Finance, which is mainly into gold loans. And then there is Manapuram, which is also into gold loan and microfinance. This is a segment which is going to grow at more than 20% for times to come. So somebody like a Bajaj Finance will not find it difficult to grow at more than 20%. But the problem is that Bajaj Finance has gained so much size that at some point RBI is going to tell them that, hey, you've become very large for an NBFC, you have to convert into a bank. So I see that as the biggest risk for Bajaj Finance. Though it's a great franchise, they have they have created such a niche for themselves that it was such a large segment which banks were ignoring, and Bajaj Finance really captured that segment well over last 12 years. But yeah, there are challenges around this, and Muthoot Finance is largely into gold loans. They were the leaders. They are still the leaders, but I think being a single product company, you have to face a lot of risks, and some of those risks are there's too much competition now. So Muthoot Finance will take some time to bounce back. But yeah, it's a good company and undergoing some temporary kind of a stress because of the competition. Then we come to the diversified financial companies. Okay, companies like Piramal, IIFL, Poonawalla, L&T Finance, Aditya Birla Capital. See, when we analyze these diversified NBFCs, typically, I have never been a fan of these diversified companies because see, when you are a bank, you should be diversified because you touch a lot of aspects of the economy and of people's life. But being an NBFC, it is best that you have a certain kind of niche. So when somebody says I am a diversified NBFC, it automatically means that I do not have any niche, and that is something that really does not gel with our GreenEdge philosophy of investments. That you really have to have some sort of niche if you are an NBFC. And let's look at Piramal for example. Piramal used to do builder loans, so that was the largest component. And when the ILFS crisis happened, the builder loan part had so much trouble that they took them 4 years and two rounds of capital raising to just survive through that crisis. Now they've acquired DHFL. They're trying to do a lot of retail lending, but it's a very tough business to build. We've always said, like, Resha said for Nestle that it took them 10 years for Maggie to become profitable. Similarly, retail is such a tough business that if I start a new product today, I'll make profits only in the fourth or the fifth year. So if Piramal is going to start investing in retail businesses today, profits are far, far away. IIFL is someone who is diversified, but they have some sort of focus on gold loans. So amongst the diversified companies, I think IIFL has a slightly better chance of succeeding in terms of high ROAs, high ROEs, and less cyclicality. Poonawalla is something where I struggle to find what is the niche of that company. They are trying to emulate the Bajaj Finance model, but it's really, really very difficult to emulate the Bajaj Finance model. L&T Finance is again present in tractor finance, microfinance, rural finance, all those sort of rural lending. But they really do not have a niche. They are present in a lot of areas. Their only niche is that it's an L&T company. They can borrow at 7.5%. So I think L&T Finance can benefit from the good cycle which we are seeing in these sectors. But yeah, in the long term, it's very difficult to say that there's some niche about these companies. AB Capital, again the same problem. We struggle to find what is the niche in AB Capital. So the turnaround which the new CEO is doing may last for 6 months, 12 months, but beyond that, it's a struggle. So that's about diversified NBFCs. Then the second last segment is microfinance. This is a segment which is undergoing an upcycle. In microfinance, you bet on companies who are very good on collections. Companies which really focus well on having uh, a good collection network. So microfinance, as you guys know, is a very, very village level kind of a business. Very, very person specific. Like, you have 10,000 employees, 15,000 employees, and they interact with 5 lakh, 10 lakh clients. So it's a business of scale. It's a business of operations. So you should have excellence on the process and people side. And amongst all the listed companies, uh, you know, Credit Access and Arman, these two companies really have been able to demonstrate good collection behavior even during demonetization and COVID. It's a testimony to the fact that they have their processes and risk management run very well. The other companies, companies like Spandana, they're trying to turn around. Whether they are successful or not, time will tell. Uh, and then you have Fusion MFI. They've grown very, very fast. Very fast growth is always dangerous in this segment. So MFI is one segment where there is a short, short-term uptick, but obviously, these are very cyclical sectors, so you have to be careful that you don't overstay in this sector. And lastly, there are broking companies and asset management companies. See, these companies are typically linked to the market, capital market cycle. Right now, we are seeing that a lot of investors are quitting the market. Stock markets are not going anywhere. Mid, small caps are correcting. These are typically times when these broking and AMC companies they don't do well. But these are the times when you actually go and buy these companies slowly and steadily, because India over the next 5-10 years the capital markets will continue to grow because we are just at 7-8% penetration. So this is a very very broad summary of the entire sector. There are good companies and not so good companies across the spectrum. The good companies should be a part of your long term portfolio, and the not so good companies are more like special situations where if you get certain insights that okay, this company is turning around, you can invest because a lot of money is made in the upcycle. So that's where I'll stop, and we can start taking questions. I think I've overshot my time, but yeah, we
Yeah,
can
we
start
can
taking.
start taking. Right, Digant. And like for our attendees, the names taken during the conversation were purely for illustrations. Please don't construe that as an investment advice by any means. So yeah, Aditya, you can go next, and then we go to Ravi and Vineet.
Hey Digant, hi, how are you? I just read your microfinance article as well. It was a fantastic article. So I just wanted to pick your heads on three questions that I had. So, what do you think of, first of all, what do you think about the gold finance companies? The gold finance NBFCs continue to lose market share given the high rate of interest that these guys charge, and banks have continued to scavenge on the gold finance portfolio. So, what do you think on the gold finance companies, Muthoot Manappuram, just broadly, purely a view? That's first point. The second point is I did have a call with the Arman management. So some very strange things that I find is on the two-wheeler on the microfinance side of it, they load lend at about 24%. On the MSME side, they lend at 35-36%. So Savi also from 2.2 asked this question: whom exactly are they lending to at 35%? Is are those people to whom nobody wants to lend to? And unfortunately, the management could not correctly answer to whom are they lending to. So don't you think that 30-35%, which they have disclosed in their presentation, it's a highly risky business. I agree with you that they have been able to collect really well. But what happens when they go from 1,000 crores of AUM right now to about 2,500 crores, and they lend at about this uh, insane rate of 35%? That's the second point that I wanted to ask. And the third question that I wanted to ask you is, so what do you think about Poonawalla FinCorp putting 3,500 crores or thereabouts in Magma FinCorp, and then selling off the housing finance company for about 3,900 crores and getting back all the capital and taking advantage of the sharp run up of the stock price of Poonawalla FinCorp. So what does it tell about the management that they've got all the capital out of the system? Now they're targeting very aggressive loan growth, 35-40%, and nobody understands the underwriting quality, or the book is not being seasoned. So these three questions. Thank you.
Right. Thanks, Aditya. Thanks for these wonderful questions and thanks for the kind words. So I think you've been tracking the sector quite well for asking these pointed questions. So let me take them one by one. So see, gold loans is gold loan I think of gold loan as a poor man's credit card. Okay, so people like you and me can get credit cards, and we can swipe our cards whenever we want to spend. But only around 1.5 crore people in India really get credit cards. So for everybody else, there is no instant, no questions asked loan on demand which is available, and which is why gold loan is a very, very large category in India, not just with the banks and the NBFCs, but the money lenders at the local level are also very, very large in this segment, because it's a instant loan and a no questions asked loan. Like, I'm not going to ask you, hey, why are you taking this loan? Where are you going to use this money? And all. I just get the gold and I give you the money. So this is a sector where which is a very difficult sector to operate. Why I say it is very difficult? Because people take gold loans only for a very short period of time. Maybe it's 1 month, maybe it's 3 months. It's never beyond 6 months. So it is a very, very operations heavy business, that you will have hundreds of transactions happening in your branch every day, that customers come, give their gold, you check that, you keep it, they come again to release it. So it is a very branch intensive operations. Manappuram and Muthoot have perfected these gold lending operations. But looking at the profits which they made in the last cycle, everybody got so attracted to gold loans that after 2020 we had an explosion of all the banks jumping into gold loans. See, now when a bank decides to target a particular segment, they will hire 200 people. They will give spare 50, 100 crores to try out that particular product. So right now we are in that stage that every bank is trying out gold loans. Nobody is claiming that, hey, I am very successful and I am very profitable in my gold loans. So I think these banks will also realize at some stage later that, okay, I built 1,000 crore loan book today, but if I don't bring new business every day, this 1,000 crores will run off in the next 6 months. So it's a treadmill that they have to go on. So it is a very operations intensive business. So only those banks where the branch per branch AUM can actually go beyond 15, 20 crores, they will be the ones who will be able to make 2% ROAs, or something which justifies so much effort. So I think we are at a phase where a lot of new entrants have come, be it startups, be it banks. But we are already seeing fatigue setting in, and maybe over the next 1 year, as the excitement around gold loan reduces, you will have competition reducing. So Manappuram, Muthoot both will struggle for the next 6 to 9 months. There's absolutely no doubt about that. But then, when the valuations become cheap enough, we know that these are businesses which only a focused player can do. So Muthoot will specifically bounce back, say 12 months, 18 months later. Uh, but yeah, that's it. They have to suffer right now, and they have to continue to do what they've been doing. What I don't like about Muthoot is that they have to really try some new products, because being a one product company, you're always open to attack, from different sides, and this is precisely what we saw in the last 2 years. So that's on the gold loan companies, that they'll suffer, but the best player here will probably come back once the competition intensifies.
If I just can ask you one question
Right.
about the gold loan companies. So do you think that in the past that the higher interest rate of about 20-22% that these companies were charging could, because of banks coming into this, into foraying into gold loans, maybe not as aggressively as well, but could that permanently mean that they will not be able to charge these kind of interest rates? I will give you an example. I do consult for a bank, and I have come across in small areas where people are not ready to take home loans at about 12 gold loans at about 12 to 13%, saying a larger bank is giving at a much lower rate, at a rate of about 9 to 10%. So do you think from a strategy point of view that these guys need to strategize and think about lowering their interest rates?
See, interest rates is a function of many things. Okay, so if you want to take a 1 lakh rupee loan, and if as a bank I'm offering that 1 lakh rupee loan at 12%, I'm going to lose money on it. I'll not even make a single rupee out of you, because the operating costs are so high. But if I'm going to take a 5 lakh or a 10 lakh rupee loan at 12%, I might still make some money. So I think that interest rates is a function of how large your loan ticket size is. So I still think that the market below, say, 2 lakh kind of a loan size, you can still charge 18 to 22% there very, very easily, because that's the only way you can make 2 or 3% kind of ROAs, because the operating costs are very high here. This is the area where Muthoot and Manappuram really are the champions. But there is obviously the city-based large customers, which earlier were with Muthoot Finance and borrowing at 14%. They are now going to the banks at, say, 11%. So that is a segment where some dent has been made. But as I said, that some banks will tire out. Once they make their PNLs after 2 years, they'll realize, oh, I'm not making so much money as I thought on the gold loans, and so much of my branch infra is getting used. Let me increase the rate. So just for your information, before COVID, HDFC Bank and Axis Bank used to do gold loans at 14 and 16% respectively, and then they used to make some respectable IRRs. So right now, I would say it's a phase of irrational pricing, irrational exuberance. We just have to wait out for this irrational phase to go, because nobody has done that PNL and unit economics kind of work on gold loans. So right now, it's just let's go build a business. After 2 years, all these exercises come. So I think interest rates are not very, very important for the small customer. For the small customer, service and availability is important. For the large customer, interest rate is obviously important. But yes, fair to say, Manappuram and Muthoot, they have to innovate. They have to, they cannot go back to 22% on the whole portfolio. They'll have to live with maybe 17, 18%. They have to go deeper inside India. They have to try and get the money lender customer into their fold if they have to maintain their 18, 19% kind of EVs. So that's on the first question. Second question, you asked about Arman lending at 35% in MSME. Let me tell you that this what Arman does in this segment is Kirana shop financing. Your Panwala, or some small unorganized Kirana shop. So see, nobody gives them money. Nobody means absolutely nobody. Now there are only 2 or 3 more companies who give money to them. So one is Paytm. Paytm has a lot of these installations at the merchant. आप जब भी merchant के पास जाते हो और वो Paytm करो करते हो, तो Paytm के पास वो merchant का थोड़ा बहुत data है. So Paytm is also built a 2.5 to 3,000 crore book at 35% yields. Now, why 35? It may seem that this 35% yield is very, very high, but see, it's a very small loan. It's a 1 lakh 50,000 rupee loan, and it runs down in like 3 months, 6 months at max. So for that particular person, availability of finance is far more important than the interest rate which is being charged. And see, on a 1 lakh rupee loan, 35% or 25% per month, 200-300 रुपए का फर्क पड़ता है, if you have to calculate. So on a very small scale, this is possible. But you asked a very relevant question: can this scale from 1,000 crores to 5,000 crores? Answer is absolutely no. It cannot scale, and which is why when I said that IDFC Bank has built a retail book of 90,000 crores, which is yielding 14% IRRs, it obviously entails a lot of risk, because at this scale, when you charge this interest rates, a lot of risk gets into your system. So I think this segment is very, very nascent. Like IndusInd Bank has built a 3,000 crore portfolio here through what is called as merchant finance. So I think early days yet, but yeah, for the scale which Arman has, I think they are doing a pretty good job. Lastly, you asked on Poonawalla that they bought at say $100, the price immediately became 300. See, Poonawalla FinCorp, I would say that see they have no real experience in NBFC, and their actions after they took over the NBFC, so they have something called as the defocused portfolio. Now, surprising part is that the vehicle finance was always the strength of Magma, and that is the part that these guys are trying to defocus on. So they are really thinking of Bajaj Finance as the ideal NBFC, and they want to build a Bajaj Finance like organization. But we have to understand that Bajaj Finance built this in 2010 to 15 when there was no competition. It was the first mover, and a lot of these retail shops, electronic shops, they had no one coming to them. So Bajaj went and captured this market. None of these conditions are present today. So I am myself really confused as to what strategy Poonawalla is trying to pursue. And at 3x, 3.5x valuations, there is absolutely no room for error. They sold off their housing finance business, which tells us that they are not really in the game for long term, because who would sell an affordable housing finance business if you really want to build a great NBFC?
Fantastic. Thank you,
Fantastic. Thank
Digant.
you, Digant.
Thank you, Aditya, for your questions. Yeah, Vineet, you can go next.
Hi, Digant. How are you? I've heard you a lot on different forums. Am I audible?
Yes, yes. Thank you so much. Blessings of people like you help us go ahead.
I have a few questions which I sent to Prince also earlier. I think you would have already shared. But going back to the gold loan, is there something has changed structurally? Because gold loan used to be a very localized business. Uh, Evaluation, etc., has to be done very locally, and most of the banks, since they are centrally managed, have things changed in that scenario. That's why they are able to capture the business from these gold loan providers, or is it just a short term blip and they're trying to maximize their ROAs in a shorter run, but it's not a long term phenomena? I'll come back to other questions, but I just want to start up with this.
Yeah, yeah. So see, it is very difficult to say that what the future will be like, but see, surely all the banks realize that if we have to grow for the next 10 years, our retail portfolio has to be complete. We just cannot depend on housing loans, LAP, and car loans. We will have to bridge a lot of gaps which are there in the portfolio. So a lot of banks have hired new teams. They are trying out gold loans. They are trying out unsecured business loans, two-wheeler loans. They are entering a lot of these new segments which they were otherwise never doing. So someone like a Kotak has hired a 200-member team, to for gold loans. So I just think that this something permanently has changed for gold loans, that it is no longer a four-player market. Uh, I think out of 25 new players which have come in the last 2 years, with between startups, NBFCs, and banks, at least four or five will become successful players. It's definitely not the case that all of them are not going to be successful. Four or five of them will crack that code. They will emerge stronger. So in that way, you are right. It was the monopoly of these South-based NBFCs. It's no longer the case now. They will have to contend with more competition than in the past. But I think in the next 1 or 2 years, out of these 25 new entrants, at least 10 to 15 are going to just drop their plans in gold loans. So I think we are probably at the worst time for the sector. Things will get better over the next 1 or 2 years, but they will not get as better as it was in 2016 to 19.
All right. So I have a few questions on the banking sector in the macro sense, and then I have a small question on the food for Resha. So I'll first ask on the banking, and then I'll move on to Resha. Uh, Banking system liquidity had been very tight since past 12 months, and RBI has recently done some LTROs. Where do you think this is all leading to? Because the continued deposit scenario being so tight and the credit still being much high growing rate than the deposit, where are we looking at in terms of liquidity?
See, so this is a very very complex subject, but let me just simplify it for everyone. That let's see, liquidity in the economy can be created by RBI. Okay, so if the deposit growth today is such a big challenge, it is only because RBI feels that if I create more liquidity, there is going to be a pressure on rupee. And just because the global backdrop is so tight, there is inflation across the world, there is rate tightening, there are FIIs who are pulling out the money. So if the liquidity in India becomes very easy, like if the RBI pumps more money, prints more money, what is going to happen is the interest rates may drop for the time being, but then we will have even bigger outflows from India. because the inflation and the interest rate differential between India and the developed world will change. So I think it is a very fine balancing act which the RBI has to do. And this is not the first time that this is happening. Over my career of tracking the banking system, this happened, very extensively between 2014, between 2012 to 2014, once again in 2016, and then in 2018. So this liquidity and tightening of interest rates, it is a temporary worry. I don't think it is a very big worry. Whenever the global situation normalizes, you will automatically see that liquidity will ease and deposit growth will start coming in, which is why I will tell everyone that these are issues which are not very very long term in nature. They are short term, or maybe 6 months or 9 months kind of a time frame where these issues will be there. And if you want to be more careful on your investments, you should invest in banks and NBFCs which have a very good deposit or a liability profile, like somebody who has a lot of CASA, someone like ICICI Bank, Axis Bank, they have brilliant liability profiles. Even a federal bank has a good liability profile. On the NBFC side, a Bajaj Finance or a Chola or a Shriram, these guys have absolutely brilliant liability side. So they will be impacted less. So I don't think that this deposit growth will constrain us for a very long time. It's a maybe 6 month to 12-month issue. US, once the rates peak out in the US, we will start seeing easing conditions in India as well.
And Digant, considering almost all major banks in India are FI heavy positions, since FIs have been selling, their multiples have gone down as compared to their usual historical highs. Do you think the sector as a whole has derated, or I mean, is there some structural change in the rating for the banks, or do you think it will come back to a situation where they will be the most sought after sectors, because this is the major profit pool in the economy? So I just wanted to have a views on that.
Yes, Vineet, your observation is very correct that, see, we are, banking sector is already in Amrit Kal. Okay, if you look at last quarter, growth was the best, margins were best, asset quality was the best. So, in my 13-year career of tracking banks itself, I've never seen a time where all the levers are working together on the positive side. And still, after such great results, we saw that the sector just did not do anything. So it is very clear that that FII selling is an overriding factor. FII ownership is high, and FIs are only going to sell what they have in their portfolios. So banks are really being sold left, right, and center. Having said that, see, the fundamentals are fine. Growth will come in a reasonable manner. Once the situation in US normalizes a little bit. Valuations today are, hardly, between 0 to 1 standard deviation of the long-term average. So typically a sector never tops out in such a thing. So I think I would like to believe whatever you are seeing is an opportunity to load up more, or average up slowly, because the valuations are nowhere close to the history, and the performance is the best ever in the history. So it may be a good opportunity, but obviously we never know when the US market stabilizes, when the FIIs flow stop. So we obviously have to do our portfolio allocation and slowly and steadily increase the allocation on corrections. So, and typically Adani issue, or this, if the Silicon Valley banking collapse, if these gives you 10-15% unnecessary corrections in the banking stocks, you should use these opportunities to build portfolios for the long term, because fundamentals are right there. I don't see what structurally anything has changed. Maybe a Bajaj Finance was growing at 40%, now it's growing at say 25%. So for some companies, things have changed, but those changes are very very gradual. They did not happen overnight. So yeah, we should.
And 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 Digant, since we're talking about FIIs and the long-term interest rate parity, etc., where do you see the 10-year yield curve peaking, and the interest rate parity getting back to the normal which it used to be? so that at least we can attract some funds from outside India, where the banking is the most sought after sector to be invested in India itself, banking and IT. So, if that interest rate parity or the peaking out of the cycle can be, discussed or maybe given some insights on, that can be taken a play at. And once I have discussed this, probably I'll touch something on the aggregators, payment aggregators, and then I'll jump on to Resha.
Yeah. Yeah, so again, very difficult to say, right? Because see, the problems, all the problems that you discussed actually have nothing to do with India. Okay, they have to do with whatever party happened in the US post-pandemic, uh, and the tightening which is happening now is a result of that. So I think we have to be patient. We have to wait for the environment to change. I think everything is fine with the Indian banking sector. We just have to wait for a better global environment. That's all there. I think GSEC has done a phenomenal job of being steady at around 7.5 in such an environment. In 2013, we went to 9%. When the environment was not as bad as today. So we've done a very great job there. So I think we should not worry too much about this. We should worry about getting good prices and good banks, and then the upside maybe it comes later in 23 or early 24. We really don't know, but yeah, we should use these as an
All right.
opportunity because there's no fundamental problem with the sector or the company.
No, no, no. I understand that because I've been tracking banking for quite a long time now. So, Digant, on the payment aggregators, where do you think they will sit in 5, 10 years down the lane? Is there a seat on the table for with the banks, or they will become the DSAs for the banks?
Yeah, so very, yeah, these are the questions which, we've also been debating within our circles for a long time. See, in India, the regulatory structure is such that, gaining resources is very, very tough. Like, garnering deposits, garnering liabilities is not at all easy. Like, can any of you guys name even one fintech which has a 5,000 crore kind of a loan portfolio? Like maybe Navi Technologies would have it just about there, but it's very difficult. So all I'm saying is for all the hype around the fintechs and all, it is very difficult to create a balance sheet. So most of the fintechs, including the payment aggregators, will either have to take an NBFC license from RBI, for which they will have to undergo so much of compliances that these companies, the cultures within these companies are not so so compliant to what RBI would really want. So I think it will be a long journey for them to really become large lenders in their own might. So I think the best option for them is to originate the loans, manage the customer face, but leave the lending and the balance sheet bit to the banks. We've already seen that whatever Paytm lends, it sits on the balance sheet of say an Aditya Birla Capital or a Clicks Capital or a Hero FinCorp or some or the other large NBFCs. So that highlights the challenge. So I think this is where I think the future is, because RBI has not been very very liberal with giving out lending and deposit taking licenses to all and sundry. See, US has 4,400 different banks. India just has 35. So that just tells you how strict our regulators are.
Thanks, Digant. One request, please be active on Twitter because we want to see you more and posting more about banks, etc.
No, thanks.
So so we need just since Digant is talking about Paytm and fintechs, can I ask?
Aditya, before you go
Yeah.
ahead, I wanted
Hmm.
to ask a question to Resha. That's why I thanked
Yeah.
Digant.
Yeah.
Uh,
Yeah.
Resha, I track QSR also, and considering the recent margin contraction in QSR, do you think that margin contraction has already played out, and or is there still 6 months, 9 months run up further in the margin contraction where we will see a lot of issues? Plus, second question on that is, in store sales growth has been normalizing now? Post COVID, they were jumping 25-30% every quarter. Now I think everything has normalized. What should be the usual same store sales growth expectation on a normal running basis?
Sure, Vineet. Thanks for the question. So, see, first, what you've asked is on the margins, right? Specifically for the QSR space. So, if we look at, the kind of inflation, food inflation, that the segment has seen, right? And this is not just across, let's say, burgers, pizzas, and so on, but across the entire food sector, it's been very, very high double digits over the last 18 to 24 months. Now, what happens is that, when this initial phase of inflation kind of kicks in, right, the larger organized players are able to manage their, sourcing, bring in, product, value engineering, bring in some, bit of recipe tweaking, etc., and, control their costs. So in the initial phase of inflation, this is when, your organized players tend to gain market share, right? But now, because of such high inflation not seen in almost the last 10 years on the food side, right? It has now begun to impact demand as well, right? And because now the demand environment is subdued, companies are shying away from taking price hikes, and some of these companies have taken a good double digit price hike over the last 18 to 24 months to offset the inflation, but they are still far behind in terms of having taken price hikes versus the inflation that they've seen, right? So we are going to see this phase that in fact we are already seeing this phase wherein companies across food segments and not just QSR, they are not willing, or they are reluctant to take any more price hikes, be it burgers, pizzas, biscuits, etc., right? Because the demand environment is now no longer favorable and they are seeing volume degrowth, etc., happening, right? So, in our opinion, we feel that the subdued margins will kind of, continue for maybe the next couple of quarters. If you look at pizza, the kind of inflation that they are seeing on the milk cheese front, right? It is really, really huge, right? I mean, just to give you the context, like for example, just in liquid milk, Amul has raised its liquid milk prices by almost 15% in the last 15 months. Okay, and this is very difficult for customers to digest, right? So in fact, we've even seen like a strong brand like Domino's, now shying away from taking, these price hikes to control the inflation bit. So I think the margin pressure will kind of continue, right? And also we have seen some bit of divergence in terms of the growth or the SSSG between burgers and pizzas over the last 1 or 2 quarters, right, where pizzas have kind of seen a slower growth or a negative SSSG versus the burgers, right? So that is on your first question, which is on the margins. On your second question, which is the same store sales growth, right? So here on the same store sales growth, essentially, see, those high growths that we saw, 25-30%, those were because of a base effect, right? COVID artificially, suppressed, artificially, the numbers optically look big because of the low base effect that we'd seen in COVID, right? But now as the normalcy is set in, your bases are set, I think on a steady state basis, 5 to 7% SSSG is, what is the general fair expectation generally from the QSR segment. However, of course, there could, and obviously this is driven by one, because you continue to premiumize your product portfolio. That is one. Right. For example, a lot of like, these companies, if they're trying to increase the share of beverages within their overall portfolio, right? And beverages typically are, very, very high gross margin versus, let's say, a pizza or a burger. right? So that will kind of, so that premiumization will, see some bit of flowing into the same store sales growth. And plus your general price hikes that you take every year, let's say between 2 to 4%. So, right, 5 to 7, 8% is a decent number to kind of expect on a steady state basis, right? And even if you look at, the US markets, right, despite them being so much more mature versus an Indian market, even they see, around 3 to 6% kind of SSSG in their portfolios, right? And this is driven by premiumization and your standard price hikes to beat inflation, that you keep taking. Now, obviously, there could be outliers here. Now, for example, somebody like a Burger King or restaurant brands, right, in India, they have been on an accelerated path to kind of, increase their store count, and they have a commitment to their parent, right? So there, of course, with a much accelerated store expansion plan, you can expect, much higher SSSG for, a company like Burger King. At least that's what the expectation is. It remains to be seen whether they are able to deliver or not, right? So I hope that kind of, gives you some flavor on the questions that you asked me.
Thanks, Resha. Much
Much
appreciated.
appreciated.
So, Resha, I also have few questions on. So the impact of COVID on the food sector and how it has shaped after that. So that would be one. And what is the level of investment activity as far as institutions are concerned in the food sector? And also the outlook of the whole sector with a view of 3 to 5 years going forward.
Sure, Prince. Thanks for the question. So, first is on how the COVID-19 pandemic has affected the food sector, right? So, of course, the first is the most obvious one, right? That because of COVID, people became very health conscious. They, switched from unbranded to packaged branded products where they thought that, they are going to be getting hygienic products, right? So, in fact, we saw a lot of spurt in growth in, let's say, in edible oil. So, companies like Marico saw a huge surge in, their Saffola oil, or even Adani, for that matter, driven not only by pricing growth but also by, volume growth, right? Then staples is one which is, kind of taking off, and here we have Tata Consumer, which through its Tata Sampann brand is, trying to kind of so branded in staples like, for example, pulses, etc., is, less than 5% of the total market. So they are trying to, build differentiated products here, and, charge some kind of a premium versus your unbranded staples, and, trying to get that off the ground, right? Even in-home consumption items, right, which are more like ready to cook, ready to eat, right? Be it your popcorns or be it your noodles. In fact, we all remember that, Maggie was not available on the shelf, right? It used to be out of stock, right? So in-home consumption had increased, and of course, with COVID having passed, your out-of-home consumption has normalized. And during COVID, what happened was your impulse categories took a lot of beating. Okay, so for example, confectionery, like if you look at chocolates, that's an impulse category, right? Your savory snacks, your chips, bhujia, your namkeens, etc., your extruded snacks like rings, pallets, etc. So we've seen, the numbers for Pratap snacks, or a lot of these companies, really taking the hit because out of home consumption, and it got really hit the impulse categories, right? But now we are slowly seeing a revival of these categories as normalcy has resumed and out of home consumption has increased, right? And going back to the pre-COVID levels or probably even higher. And obviously now in-home consumption has normalized, right? So if you look at the ready to cook popcorn business of somebody like an agrotech foods, right now, that because of the high base, they are struggling to grow on that high base, for now, right? And the other big thing in the COVID-19 pandemic was, of course, like I mentioned initially, that inflation in the initial stages, right, really benefited the organized players because they were able to manage their sourcing and a whole lot of other ecosystem, back end supply chain, etc. They were able to get their products, distribute their products in the market, right? So initially they saw those very healthy market share gains, right? But now after 2 years of heavy inflation, like for example, just something like a biscuits, right? Over the last 18-24 months, it has seen like a 33% kind of an inflation, right? And even a company like Britannia, despite being the leader, has probably been able to pass on only 22% of the inflation in terms of price hikes, right? So clearly market share gains in the initial phase of inflation, but now they are also seeing that subdued demand, etc. Which is playing out for them, and inflation is hitting their profitability and the overall consumer sentiment. So that's on the first question in terms of and yes, one more thing here, that yes, people have become open to a lot of innovations and trying new products, right? So that's a new thing that has happened, and people got exposed more to snacking options, like let's say an energy bar or a protein bar from a snacking perspective, and a whole lot of those kind of products, right? So that those are some of the changes that have happened in the post COVID phase, right? So Prince, sorry, what was your second and the
And the Yeah. So before I come to second question, Risha, like any view on the cloud kitchen concept? And there have been, I mean, I heard in one interaction like they were starting leasing cloud kitchen as well. So any view on that thing, and where the profit pool actually lies?
Right. So, see, cloud kitchens as a concept did exist even before COVID, right? And somebody like Rebel Foods, right? The biryani player, etc. They did exist before that. However, that accelerated post the pandemic, and where we saw, because that option of dine-in, right, was not there during COVID. We saw a lot of incumbents also pivoting to and starting cloud kitchens, etc. So somebody like barbecue nations, right, they started a cloud kitchen, and there was a whole lot of euphoria around that. So yes, certainly now things have normalized. So in fact, we see a lot of these players kind of announcing that they're going to be scaling down their cloud kitchen plans, because as economy has opened up, their dine-in business has kind of come back, and maybe the unit economics is also not working out for a lot of these listed players, right, on the cloud kitchen side, right? So that is why they have decided to scale that down. In fact, I think I even remember reading Swiggy had kind of decided to shut down or significantly scale down their cloud kitchen business, right? Having said that, of course, cloud kitchens will continue to coexist with your existing ecosystem, right? It will be on a higher base versus pre-COVID, right? But yes, certainly the euphoria seems to have settled for now as the economy has opened up.
Right.
Prince, if I
Prince,
may
if I
just
may just
add your
add your
sorry, if I may just add here, the profit pool. See, in India, because restaurant discovery is a very big deal, right? So, because we don't have a lot of organized chains, so restaurant discovery becomes very, very important, and which is why we think that the profit pools are eventually going to shift to companies like Zomato and Swiggy rather than to the actual cloud kitchens.
Right. So Resha, second question was around like what is the level of investment activity on the part of institutions in the sector, and a broad outlook going forward for next 3 to 5 years.
Uh,
Right. So by investment
So
activity, do
before Resha can chip in, we and me and Resha, we joke that in financial sector we always worry about asset quality, and in food sector we always worry about inflation. Okay, so so now you have the finance sector, there is no asset quality issue, and in food sector there is a lot of inflation issue. So the institutional activity is also going to follow that. At least that is what is my guess. Resha, you can go on. Yeah.
Yeah, so clearly in terms of Prince, in terms of the investment activity, right? So across. So if you look at sub segments of these consumer companies, right? We're seeing the sentiment, because on the demand side it is subdued, and because of high inflation hitting profitability, and we expect the grind to continue for a few more quarters, right? Until inflation settles down, demand is not coming back in a scorching way, right, in this segment anytime soon, right? So until that happens, in most of these pockets, if you see, right, be it the QSR space, right, or the casual dining space, where we have barbecue nations, or we have these food and beverage companies like, let's say, a Nestle or a Tata Consumer, right? You're also seeing that reflected in the stock price very, very clearly, right? So maybe except for something like biscuits, right, where maybe because Bector Foods, for a company specific reason, the stock price is really reflecting that kind of growth opportunity, etc. And maybe Britannia, also because a lot of inflation seems to be behind, right? And that's why the stock is trading at close to 52-week high. But in otherwise most of the pockets, food, including FMCG, consumer, right, even if you talk about the likes of Dabur, Marico, etc., right? A lot of these companies, the stock prices really kind of tell you the sentiment story, right? Of course, out of home consumption companies, right? Some like Pratap Snacks, right, with the Yellow Diamond brand, right? They have seen, some bit of renewed interest because out of home consumption has come back. Maybe, the worst of palm oil prices or the inflation is kind of behind them. Right, so some of these out of home consumption categories are seeing some sort of interest, but and even if we look at dairy, right, for that matter, even if the sales growth has been coming in, but margins clearly have been impacted, and they'll take 3 4 maybe 2 to 4 more quarters to kind of come back, right, as the flush season comes in, and the artificial insemination cycle kind of delivers the results, right? So clearly that's on the investment sentiment bit on the foods company side, right?
Yeah. So Prince, you can go ahead. Yeah.
Okay, yeah. So Ravi, you have your questions. You can go next.
Sure. Thanks, Prince. Thanks, Digant and Resha, for sharing your insights on food and lending businesses. Uh, I have few questions on food, and then I have few questions for Digant as well. Uh, since we were talking about, say, QSR, one thought which I used to have for last few months was, say, for last 6 7 months or 2 years, delivery was very much done cheaply by the Swiggy and Zomato guys, and hence it makes a more business sense for a burger business in India, which is typically 200 to 500 for a two person or something like that. While the cost of delivery is that not significant when it comes to Domino's and pizzas. Do you think that once Swiggy start charging nominal that 80 100 rupees, there can be a dent on the burger business growth? And maybe since Domino's manage their delivery mostly, I guess, by their own, it can be a rating for Domino's here. Prince, you were mute.
Sorry, I think off in between. And also your voice was breaking, so I'm not very sure of the question. Digant, if you've heard it and you want to attempt it.
Yeah. So I think I heard it a little bit more. So see, what Ravi is asking is that because now the delivery cost will actually start going up. Would a low value item like burger still do well on the delivery side, right? Is that the question, Ravi?
Yeah, I can repeat. I can repeat. What I was saying is, say last 1 year, something like Zomato and Swiggy used to deliver below their cost. Okay? And so a burger product which comes at 200, 500 for a one person, two person, it makes a more business sense that logistic cost is lower than as a small portion of the overall
Yeah.
product.
Right, right. I got it. So let me try and answer. See, 3 years back, all these delivery boys, Zomato and Swiggy were the primary people hiring them. In the last 3 years, you have now so many new companies which have come up. Like a Blinkit would have come up, a Dunzo would have come up, a Zepto would have come up. So actually, there is a lot of competition for hiring these delivery boys also, and which is why the delivery costs have gone up because of that. Plus the two-wheeler cost, buying a two-wheeler is become more expensive. The fuel has become more expensive. So delivery costs have gone up, and there's a lot of pressure on Zomato and Swiggy to show profits also. So I think Zomato in his calls have clearly said that we don't want to focus on the office lunch segment, because people in the office where average order size was 130 rupees. They said that, yeah, ya to we will charge 50 rupees delivery, and or else we don't focus on this segment because they are really losing money. So I think this whole delivery model itself is going to change because there's a lot of competition for the delivery boys, and the economics are such that if you are going to have orders which are less than, say, 220, 230 rupees, it's going to be very difficult. And when you charge 50 bucks, a lot of the demand will go away because people don't want to pay 50 bucks for delivery. So I think this space is in some bit of troubled times, honestly. The entire food space, especially these QSRs and more of these delivery guys, because the costs are really going up, and if you pass on the cost so fast, a consumer the growth is going to go down. So either ways you are going to get hit. And let's remember, food inflation is coming after 12 years of absolutely no food inflation. And when something starts going up after 10, 12 years, it just does not stop in 1 year. So which is why, in the food segment, as Resha said, we are very selective. Dairy is one segment which is used to inflation for a long time. So dairy is one where we think the cyclical, turnaround is around the corner, and obviously tobacco is one space where inflation does not really make a dent. So yeah, Ravi, I hope it's answered in at least certain degree.
Yeah, my second layer to the question was, since the percentage logistic cost will increase for burger, do you see a case for re-rating for pizza businesses here? Because Jubilant and all got derated in last 1 2 years, while Westlife got because of the support they got Swiggy and Zomato.
I,
Right now,
I
sorry.
think Resha already answered that, but yeah, Resha, you can go at that. There are more stores, and see, their delivery was good because more stores got opened, and once the uh, out of home opened, their dine-in part did really well, and Domino's does not have that dine-in part in a really nice way.
Right, and I think the re-rating, de-rating that happened in Westlife or in a Jubilant are because of company-specific reasons, right? So if you look at Jubilant, there have been a lot of challenges for them on a lot of fronts. Okay, so one is SSSG, plus the other is not being able to take adequate price hikes to beat the inflation, especially on the cheese front. Thirdly, in pizza category, it seems that inherently the competition is a lot more now versus, let's say, a couple of years back, right? So it's more to do with company specific factors. And if you talk about Westlife, so they have really turned the corner, right? So if you talk about their menu innovation, product innovation, they are focused on beverages, also on the chicken front, right? Especially in the south part where chicken is a big part of the consumption. So that is again a high margin kind of a product, right? So they are focused on chicken, and so these kind of initiatives have really worked out well for them, and that is clearly reflected in and plus their SSSGs have also been healthy, right? In fact, amongst the QSR players, all the QSR listed players currently, Westlife is the one that has been doing well, right? And it's because of these factors essentially that they have been doing well and they have got re-rated.
Sure, sure. One thing about heritage, what sense you make about this right issue of 23 crore on a 15 crore, 1500 crore market cap? They could have done without this, also they have done with borrowing. Because what it has done is it increased somehow the shareholding of the promoter was increased. Maybe they bought the entitlement or and then the family office from Hyderabad, their stake is increased by 1%. Why I ask this is because in this dairy line of business, in the delivery side, there is huge scope, but people only trust Titan. And fiasco which has happened on the dairy side has been long list. You start with quality. Prabhat was there. Parag still struggles, though now Nikhil Bora is there. Uh, so, since you make of that,
The right issue was a distraction. One word from our side is, right issue was distraction, totally unneeded. Maybe it was a backdoor entry for promoters to increase the stake before the good cycle kicks in. At least that is what we treat it as. It was totally not needed.
Right, and I think Ravi, you also alluded to maybe some corporate governance issue or something in Heritage Foods, right? So I think yeah, based on if you look at their numbers, etc., cash flows, etc., over the last so many years, more than something like a corporate governance issue, we would rather say that one thing that has weighed on this company is the political risk involved because the promoter is a politician, right? And in fact, if we look at this particular risk right now, it's mitigated because they are not in power and nor are they in alliance with the center, right? So we believe that that risk is also mitigated, but corporate governance issue is something that I think over the years their cash flows, etc., have kind of spoken about, right? And more so, this company, like I said, is why we are kind of looking at it is because we feel that there is some turnaround that is happening with the new CEO that has been hired, which is reflected in their top line growth, which has finally started coming in, right? Of course, margins is a problem for the entire food sector and not just dairy, but in dairy it is more cyclical and more aligned that ways, right? So but otherwise we think that their focus on driving sales growth, driving sales and distribution is something, if that they can continue to deliver, then it is a value stock to kind of look at in this space.
okay. And lastly, I think you didn't mention Parag purposefully, but if Parag starts delivering double digit 13-14% EBITDA margin because they do more value added than the pure milk player of Andhra, they never delivered that kind of margin. If they do deliver that kind of margin, will you consider that as an investment case?
So Parag, honestly, we've stopped tracking. I think the kind of write-offs, etc., that they've taken, their inventory issues, etc., raises a lot of red flags. You can just go back to their numbers, etc., and see the write-offs that they've taken, plus what is happening with their cheese inventory, right? That does not give us any comfort. So in our scheme of the GreenEdge way of investing philosophy, it does not give us any comfort at all, right? And our universe here in the listed space, would rather be confined to Hatson, Dodla, and Heritage, right? And also, you spoke about, they having value-added products, etc. Yes, they have a large share of value-added products, but again, see, the assuming all is okay with their inventory issues, etc., etc., right? Cheese essentially is a long shelf life product. In fact, depending on the quality of cheese, you need to cure it for 3 to 6 months. So your inventory days will be higher, right? It's a long shelf life product. Plus, depending on the strength of the brand, your receivable days can also be a lot higher than, let's say, something like a fresh product, like a liquid milk or curd, right? So clearly, even if your margins are very high, say 15 to 20% for a segment like cheese, but your return on capital employed, because of high working capital, relatively lower asset turns on that particular segment, right? Your ROCs, will be pretty low unless you are
able to scale up that business, build a dense distribution network, build a strong brand so you can command that pricing power, negotiate those kind of trade terms with the retailers.
Sure.
Sure. So,
Did I have
Prince, can I take all the questions which are in the chat box, or like quickly I can.
Digant, I was about to ask. And secondly, like we are good on time, right?
Yeah, we can continue for another 12, 15 minutes. Resha,
Yeah, I think till 8:15 is good. Yes.
Yeah, great. So those questions also, and Digant, like I heard you talk on LIC on various forums. So insurance as a space, how you see it has panned out, and like after the LIC IPO and say the recent developments after the budget. So how you see the sector going
perfect. Perfect.
forward?
I'll talk. I'll talk. I'll just quickly, finish off the questions on the chat box, and then I'll spend 3 minutes on insurance also, because we have a good view on the sector. I think what is value has asked about Mannapuram Muthoot diversifying into MFI. I think Mannappuram's track record in diversification has been very, very patchy. So we cannot really bank on the microfinance business delivering great numbers. Gold loan is a very safe business. Microfinance is a very risky business. So Manappuram may be cheap, but the pain period is still going on. That's a quick reply. Then Arun Kumar Mittal has asked, shouldn't we bet instead of AMCs on companies like CDSL, CAMS, BSE, NSE? You're absolutely right that see BSE, NSE, CAMS, CDSL, these will be more stable companies. Like in a down cycle, their earnings will not drop as much as they will for a broker or a mutual fund company. But then they are expensive also. CDSL, CAMS, NSE, BSE all are trading at good multiples versus a broker. So, for example, ICICI Securities is trading at 12 times earnings. Motilal Oswal is trading at 7 times earnings. Uh, you know, this CDSL is trading at 30 times earnings. So, if you are an investor and if you know that the capital market cycle will change, you should have actually both. You should have one of this CDSL or CAMS, because they will be like a quality compounding story. And you can have one broker or a one AMC like a Nippon, which can give you higher delta. So, at GreenEdge, we try to play both, which is why, Resha mentioned Hatson and Heritage. So, if our call goes right, Hatson will give X returns, but Heritage will give much more returns if our call goes right. So we try to balance the risk and reward this way. So that's for Arun Kumar Mittal. Then there is a question that how long does the credit cycle last? I think Srinidhi Bajoria has asked this question. When do you see the valuation peaking? Typically a good credit cycle will last for 2 to 3 years. And in India, our banking sector, it's just been 1 year of good credit cycle. So, and then because of the whatever is happening globally, I think we are slowing down because of that. So maybe this time the credit cycle can actually last for 2 or 3 more years. But obviously, this is too futuristic. We cannot really take accurate calls at this moment. What are the peak valuation matrices to keep in mind? I think price to book is a good metric for the entire banks NBFC sector, and tracking valuations versus the past is a very good idea, because it's a very, very accurate reflection of the changes happening in the company. I think I mentioned that versus the past, we are only at say one standard deviation higher, and then typically, it's I would say that we are not in an expensive zone as far as the banks and NBFCs are concerned. Then there's one question by Balu Saheb, that what does Digant Haria think about broking firms who are growing the non-broking business like distribution? We are very positive on broking companies, because a lot of them are converting themselves into wealth management companies. So they will be less cyclical, more secular in nature. So ICICI Securities, Motilal Oswal fit the bill. They are extremely cheap. So maybe next 6 to 12 months are good accumulation time for these stocks if somebody is looking at this sector. Then there is a question about Silicon Valley. We've discussed it doesn't really impact India. And then what is your view on small for Equitas Bank? I mentioned that Equitas has created a good liability franchise. It's the that and AU Bank are the only two companies which have created good banking structures. So, and Equitas also has one very good micro lending business, a 7,000 crore book. So Equitas has potential, but obviously there's a uncertainty on the leadership, like how long will the promoter come founder continue, because it's a institution owned bank. There is no promoter stake is very low, and hence we it does not fit our framework of long term investing. Can you please comment on South Indian Bank as a turnaround and the risks? So South Indian Bank is turning around as you have mentioned, but you have to be sure that this is a cyclical, a cyclical kind of turnaround, which means they'll do well for 1 or 2 years and then they'll hit a peak. Murli, who is the current MD there, he is from ICICI Bank. He has very good experience in the banking sector. If he continues to lead the bank, I think the turnaround will last for longer. So you have to track whether he gets an extension after his tenure completes, in 23. And then digital money lending, is it a threat? Question by Yashwant. You already answered that all these fintechs, will actually go and aid the banks. They will not actually cannibalize the banks. So I think we have finished the questions from the chat box. Now we can just take question. Prince had asked on insurance sector. So see, we always have reports which say that India is a very underpenetrated sector, and it's a sector which can grow at 15% CAGR. We at GreenEdge have a very different view. We believe that insurance is a very well penetrated sector, especially if you consider the top 10% of India's rich population. Okay, so all of us either have some LIC policies and general insurance, health insurance. So when we take the entire population of 140 crores, it seems that insurance is very underpenetrated. But we all should acknowledge this, that who can buy an insurance? Somebody who has a lot of spare money, right? Somebody who does not have a lot of spare money is hardly going to buy insurance. So on the life insurance part in India, we sell it more like an investment product and less like a insurance. So they had a big tax advantage versus a mutual fund or direct stock investments. So a lot of the HNI circuit in India used to invest in these insurance products. I think this budget government has made it clear that over a period of time, a lot of these tax advantages are going to be taken away. So I remain quite skeptical on the growth prospects of the life insurance industry, which is typically your HDFC Life, SBI Life, iPru Life. Some of these companies are good companies, but if business built on tax advantage is something which we're not really positive on. When it comes to general insurance, it is a sector where there is some bit of under penetration and there is some bit of need also. Like everybody should have a health insurance, everybody should have a car and a bike insurance, and the insurance amount keeps going up with the inflation, so there's a natural growth rate also. But there are too many players. There are 25, 30 players in this industry. There's so much of undercutting that profitability is very hard to come. So we like this digital player called Policy Bazaar in the segment, because whichever company wins, Policy Bazaar actually wins because it is the largest digital player. The next digital player is 1/10 the size, and it hardly has any cash on the balance sheet. So Policy Bazaar has a real good chance of making it great. It just needs, the valuations are still not within the comfort zone. The company is still expensive, but given 5-7 years down the line, I think Policy Bazaar can be a good bet to play the entire general insurance sector. We really don't have a positive view on LIC as well, because LIC is also and an outcome of the savings, not the insurance part, but the savings schemes which have been sold all across the country. So yeah, that's on the insurance bit. We think a lot better opportunities are there in the broking or wealth management or NBFC or banking space.
So Parichiti, you can quickly ask your question. Parichiti, you are still on.
Hello, can you hear me?
Yeah, yeah, go ahead.
Yeah, there were questions regarding AMCs, but given high interest rates and all, it's not necessary that people invest only in equity mutual funds, but there are balanced advantage funds, there are debt funds. So won't the AMCs also stand to earn in those circumstances?
So, hi, Digant here. See, the
Hi, Digant.
AMC's, their most profit-making product is the equity mutual funds. Okay, is equity mutual fund is where they are able to charge 1% of the AUM or thereabouts. So that's their most profitable product. Now, when we talk about the balance funds or the debt funds or the credit funds, the fees that they earn are less, and I think the markets for these are also pretty small. So equity only is a much more popular product, and see all these mutual fund companies, they are undergoing two problems. One is the market itself is subdued, and second is that the regulator in India is extra proactive. So they have come out with in 2018 they came out with the first guidelines where they were trying to reduce the total expense ratio which is charged. Now recently they have again come up with some new guidelines around broking and around how much is the peak that you can charge. So I just think that one simple rule we have learned in investing is when the regulator is behind your back, that is not the great time to invest in the sector. Let the regulatory tide subside. Let the market, this whole sideways market also subside, and then you can actually play this sector. But again, HDFC Mutual Fund is still trading at 20 to 23 times earnings. Nippon AMC would be 18, 17, 18 times earnings. So these stocks are not really cheap, and end of the day, they are single product companies. We like the wealth management companies or companies like an NSE or a CDSL more because they don't suffer so much in the downturns, and when companies earnings are less cyclical, the market rewards you with a much better multiple. So in stock markets, if you want to earn high returns, you should get earnings growth and multiple expansion both. So I think that is somewhat possible in the brokers. Brokers like Motilal and ICICI Securities, they are now not just brokers. They sell mutual funds, they sell insurance, they sell other financial products, they give those margin trading loans. So they're diversifying quite well. So so it's a buffet out there. You can select whatever you like. Everything is going to do well, but within the sector, we believe that mutual funds still have some headwinds for them.
Thanks,
Thanks,
Digant.
Digant. Thanks, ma'am. So, Digant, with your permission, last two quick questions from Ravi, if time allows.
Sure, please go ahead.
Hi, Digant. One question on CSB Bank. What's your view there? Like gold loan is not their side product. It's their core product. 40-45% of the AUM would be gold,
Correct, correct.
and and it's
So
easy
see,
to growth being in Kerala. Kerala, other players are lending at 20-24%. So and available cheap.
So see, Catholic Syrian banks, on the first look, it looks like a very good niche bank because their borrowing costs are low and they are doing gold loan business at 11, 12%. But when I think of banking in general, they hardly have any presence outside Kerala. The Fairfax management took over the bank in 2018. After that, they've tried to establish a lot of branches outside Kerala. But we have seen this, Ravi, in the past that creating a banking franchise outside your home state is a very very big challenge. You have to spend thousands of crores for years to come to to get to some kind of scale. So I just think that it's not an easy job cut out for Catholic Syrian Bank, and uh, and yeah, some years later, Fairfax will also have to bring its stake down because the government, the RBI does not allow the promoters to own such high stake for a very long periods of time. So I just think that it's a niche bank, but last 3 quarters they have been saying they want to build a credit card business, they want to build a retail business. So they want to do everything which a full scale bank wants to do. If that is the case, I think they will have massive operating cost shoot up over the next few years, and you don't make money in those phases. So which is why we think that small banks really have it tough. It's not easy.
Right, Digant. I think some issue with. Okay, he's there. Yeah, Ravi, quickly go ahead.
And another question is on MFI. Say after RBI relaxation, everyone is talking about 25-30% growth. But when we talk about overall market, we talk about that K-shaped recovery. HUL is not reporting any growth for a rural side. Entry level bikes are not selling. And if you go granularly on this MFI piece, it's more of ATP which is rising from 30-35,000 to 45-50,000. Do you see that may not be immediately 6 months, 1 year, 2 year, but eventually that will come back as a risk, this high growth piece?
Yeah, so Ravi, I'd written an article some time back. It's available on the GreenEdge website as well. And see, microfinance, the cycles are getting shorter. Okay, so the last cycle just lasted for 2.5 years. So maybe the current cycle will last for, maybe 1.5 to 2 years. We have already seen like 6 months of a good cycle. So maybe another year or year and a half is where the, cycle will probably peak out. So see, microfinance is a cyclical sector. There is no escaping that. So if any one of you are investing in the microfinance sector, you have to take that care that you are not stuck at peak earnings, peak valuations kind of a situation, because the cycles are 5 years of good cycle is just not going to happen. So you have to be careful. What you are saying is going to happen. We just don't know whether it happens after 12 months or after 18 months or after 2 years, but it's definitely going to happen. And which is why you are seeing that all these companies are, stocks have not been responding to good results in the last 2 quarters or so. But yeah, there is there's a 9 month to 12 month of good earnings which you will see in the microfinance sector, and yeah, it's a trade that way. We at GreenEdge are much more bullish on the microfinance sector bonds. Some companies like say a Spandana or a Credit Access, pretty good balance sheets, well run, good cycle, and those bonds offer 11-12%. So on the fixed income side, we're quite bullish on the microfinance, but on the stock side, you have to be careful because of the cyclicality.
So thank you, Ravi, and thank you, Digant and Resha ma'am, for your time and valuable inputs on both the sectors. And I request you both to be more active on Twitter. We trust me, like when I ask people who to invite, you were the first person who got maximum inputs. Like you should invite Digant sir, and yeah. So please be more active, and surely sometime down the line would request you again if time allows. So we will have another round of Q&A. It was really insightful. And for our attendees, the session is recorded, and very soon it will be placed over YouTube channel, and I'll share the link with you all so that those who missed the nuances can surely revisit. So Digant and Resha, any closing remarks before we close the session?
No, thank you guys for being a patient audience. It's always a privilege to share whatever we have learned in our journeys. So Resha and me, we have now been in the capital markets for roughly 9 years and 13 years respectively. So thank you guys for a patient hearing. Thank you for hosting us on the platform. It's always a pleasure to share and learn.
Yes, so thanks, Prince, to have us here, and it was indeed our pleasure and very interesting set of questions. Really enjoyed the Sunday evening. Thank you so much.
Thank you both. And I request my attendees to connect with the handles of Digant sir and Resha ma'am so that we can put an indirect pressures for them to be active more.
Sure, sure. We have been quite inactive, and yeah, we'll hopefully try and be a little more active there. So thanks, guys.
Thanks, and look forward to more such sessions. It was really, really helpful, and trust me. And yeah, one more thing, like I have pinned two tweets. One is on the session of Digant with SOIC, and that had covered whatever we discussed. So you will find it amazing, and also the microfinance article, which Ravi, you can also find it. Resha ma'am has shared this on her handle. So yeah. So with this, I take your leave. Keep showering your love, and thank you for connecting in such a large number on Sunday evening. Thank you again. Thank you, sir.
Guys, we'll leave.
Thanks,
Thank
everyone. Thank you, 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 everyone.